Ladies and gentlemen, good day and welcome to the Q1 FY2024 earnings conference call of LIC Housing Finance, hosted by Axis Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Agarwal from Axis Capital. Thank you, and over to you.
Thank you, Yashashri. Good day, everyone, and welcome to the earnings call of LIC Housing Finance. Today we have with us Mr. Tribhuwan Adhikari, MD and CEO. He has been appointed as the MD and CEO as of yesterday. And we have Mr. Sudipto Sil, CFO. I would request the MD to share his initial remarks, post which we'll open the floor for Q&A. Over to you, sir.
Good morning, Praveen, and good morning to all of you. Welcome to the post-earnings conference call of LIC Housing Finance Limited. As you are aware, LIC Housing Finance declared its Q1 of financial year 24 results yesterday. As Praveen has already mentioned, I've taken over charge as MD and CEO of this company just yesterday. Board has approved my appointment yesterday. Of course, I had joined LIC HFL on the 22nd of June, a few weeks back this year as COO, Chief Operating Officer. And in the a few weeks I've been here as COO, this has given me the confidence that we are in the beginning of a new cycle of growth. In the past few months, the company has undertaken a series of transformational changes, which include a change in our technological platform, implementation of SAP, restructuring the marketing setup by opening of 50 new offices and 44 cluster offices. This is a new addition to our structure. Improving the credit process by creating specialized credit appraisal clusters. This is what I was talking about. All this has been done to deliver a superior growth, both qualitative and quantitative, with a significant improvement in TAT and customer service. More so, since the company is now the largest HFC in the country. Some teething issues, since we had changed our technological platform, some teething issues were witnessed in the initial part of the quarter, specifically in the months of April and May. They have led to a transitory impact. However, things are improving fast, and I am pretty sure that we will deliver positive results in the coming week, months, and quarters. In terms of the external environment, RBI's rate pause decision in April and June MPC meetings has led to stability in both borrowings and lending rates. This has brought back customers into the market. Demand across all sectors is witnessing buoyancy and is likely to remain that way for most of the coming quarters. Now I'd like to share the key financial highlights of the quarter of LIC Housing Finance. Our total revenue from operations were 6,746.51 crores as against 5,285 crore for the corresponding quarter of the previous year. This is up by 28%. Outstanding loan portfolio stood at 2,76,440 crore against 2,55,712 crore as on 30th June 2022. This is a growth of 8%. If I bifurcate this, the individual home loan portfolio stood at 2,31,087 crore as against 2,09,599 crore, up by 10%. And now the individual home loan portfolio comprises 84% of the total portfolio, up from 82% a year ago. So there's a 2% uptick. Total disbursements for the quarter was 10,856 crores against 15,201 crore. Out of that, disbursements in the individual home loans were 9,419 crore as against 13,133 crore. Disbursements in project loan were 251 crore as against 309 crore for the same period previous year. As informed in the last conference call, our aim for the current year is to expand our geographical presence through opening up of new offices, which we have done. As a part of the expansion strategy, 50% new offices have been opened in the current quarter. We are also targeting a 25% growth in the number of MIs or marketing intermediaries, or if I may call it our feet on the street. Net interest income rose by 39% to 2,209.44 crores as against 1,592.48 crores for the same period in the previous year. net interest margins for Q1 financial 24 stood at 3.21% as against 2.51% of Q1 FY23. This is largely as a result of better liability management and the impact of passing on the rate hike in PLR in Q4 and Q1. Our profits before tax in the quarter was 1648.99 crore as against 1140.36 crore in Q1 of FY23, registering a growth of 45%. Profit after tax for the quarter stood at 1323.66 crores as against 925.48 crores for the same period previous year. Here we are showing a growth of 43%. In terms of asset quality, Stage 3 exposure at default as on 30th June 23 stood at 4.96%. This is the same as it was in the June quarter of FY23. Total provisions as on 30th June 23 stood at 7,590.68 crore, reflecting a provisioning coverage of 42% as against the provisioning coverage of 40% as on 30th June last year. There has been some increase in Stage 3, which is largely transitory as earlier witnessed in Q1, and also due to some technical issues resulting out of the implementation of a new technical package and software. However, the positive outcome is that there has been a marginal decline in the Stage 3 of project loans. Visibility on the recovery in that area has also improved. On the funding side, our cost of funds stood at 7.62% as compared to 7.63% as on 31/3/23. Incremental cost of funds stood at 7.69% for Q1 FY24. So with this brief introduction, I would like to invite you for queries. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to only use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, we request you to restrict your questions to 2 per participant. In case of a follow-up, you may join back the queue. We'll take our first question from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you. Good morning, everyone. Sir, firstly, if you can help us understand what is leading to this kind of a margin trajectory. Sir, you yourself have gone through multiple interest rate cycles. And I mean, from what I understand, this is not really a 3.2% kind of a margin business model. So, if you can help understand, while in the opening remarks, MD sir said that these are the impact of PLR hikes that were taken in the fourth and the first quarter. But, I mean, the kind of spreads, the kind of margins that we're seeing today, generally is not adding up. So if you can help explain that first. And then, sir, on the asset quality front also, MD sir said in his opening remarks that there has been a marginal decline in the Stage 3 of project loans. So this 60 basis points of increase that you've seen in your gross Stage 3, if they have not come from project loans, if they have not come from wholesale loans, is it predominantly retail which is leading to this kind of an increase? And so lastly, a data keeping question. In every earnings call, you share the Stage 3 numbers basis your product segments. If you can just share that. Thank you so much.
Yeah. As regards the NIM, the 3.21 NIM which you talked about is purely operational. The PLR hike and liability management has led to this. So I could not get you when you said this is not what you expected. Because if you remember, last year we passed on the rate hikes to the customers starting June. Then some of it was passed off in the September quarter and in the December quarter. The full impact of that rate, passing on of the rate hike has come in Q1 of this year. So there is an increase in the NIM. As regards your asset quality, yes, the project loans, our Q3 has come down. So basically it is the impact of 60 basis points is due to our individual housing loans. And primarily the reason for this, there is nothing extraordinary. Primarily the reason for it, let me be upfront, I think the technological change which we undertook in the month of March, that did create some technical glitches. And as a result of which our collections from our collection of EMIs from our lenders was slightly hit, in the sense, if I may further clarify, in the case most 85% of our EMIs are collected through the eNudge and nudge mode. So there were some technical glitches in our software due to which the presentment of demands could not happen in the months of April and May. So that did result in increase in stage 3, but everything has been taken care of now. For month of June and July, the presentments have been perfect and our collection efficiency is near normal. So coming forward, I see that this, I would call it only transitory, and I'd use the word an aberration. In the coming quarter, I'm sure our NPAs, if I may call it, stage 3 NPAs will definitely come down from what they are at as of now.
Yeah, Abhijit, if I may just add to what MD had said, just coming back to the query on NIMs, you are aware of the construct of the liabilities where a good amount of good portion, almost 50% plus of the liabilities are on the fixed rate side, whereas on the asset side, a large number, almost 95%, 97% is on the floating side. So in the rate, when the rate hikes were passed on, there was not a commensurate increase in the cost of funds, which we were able to hold back. So that actually led to the expansion of margins, more so because the full impact was felt in the first quarter. Whatever increases we had done in from the period beginning 1st of January and the one that we had done from 1st April, the full impact has now been felt.
So, got it. So, will it be then fair to say that given that there are no one-offs that you are suggesting in the interest income line item, given that, by now on the asset side, all the PLR hikes that you've taken have been passed on, and as we move along, your liability side will get repriced. So the margins have peaked out and should start maybe coming down from here on. Will that be a fair thinking?
No, I will not say that it will. I will not directionally comment on whether it will come down or things like that. But only thing is that if you recollect here, last year we had given a clear indication that margins are going to expand, as also in the call at the end of the fourth quarter. And we believe that there will be substantial improvement in the margins for this financial year on a full year basis. There will be substantial improvement. That much is certain, given the kind of strong set of numbers that has been given in the Q1.
Okay, so this is useful. And lastly, if you can share that data question that I asked, the stage 3, this is...
I repeat it. I will just share the details. Can you please repeat the query?
Yes, sir. So typically every quarter in the earnings call, you share the stage 3 numbers basis different product segments.
Categories, segment-wise, right?
Yes, sir.
Yeah, so as far as the individual home loans are concerned, the stage 3 is around 5,000, a little less than 5,100 crores, and the percentage is 2.2%. Then in the NHI, that is the individual, non-housing individual, which is basically the retail LAP, etc. There, the stage 3 number is 2,100 odd crores. The percentage is 7.8. Then coming to the non-housing corporate, the stage 3 is 1,630 crores. The percentage is 24%. And the project is 4,800 74 crores, and the percentage is 42.12%.
So, sir, essentially 42.12 that you said has gone up, right? Quarter over quarter was 40% last quarter.
The outstanding has come down. The outstanding has come down by almost 400 crores.
Got it.
Whereas the provision, whereas the EAD has actually come down by about 20 crores. So there's a marginal decline, but there has been a 410 crore reduction in the outstanding.
Got it, sir. Got it. And so lastly, what is the status of your restructured pool now?
Yeah, as far as the restructured pool is now, we have, if you recollect, we have done about 7,100 odd crores or 7,200 crores of OTR cumulatively, out of which about less than 100 crores still remain to go out, which will be going out in the next quarter. So almost everything has gone out. Out of that 7,400 or 7,300 number, only about 5,600 are still outstanding. The others have been repaid or closed. And the NPA, there is about around 18 to 20%.
NPS, so non-performing loans, you said?
Yes.
So what was this 18 to 20% you said?
NPA, I said. Stage 3.
Stage 3 from the restructured pool.
Yeah.
Got it. Thank you so much, sir. This is all from my side.
Thank you. We have a next question from the line of Avinash Singh from MK Global. Please go ahead.
Yeah. Good morning, sir. So, couple of questions. The first one, again, a bit on the asset quality. If we recall, this NACH glitch was sort of you had highlighted in your last quarter call. Now, if I go by stage, the stage 2 has seen increase in the absolute term as well as the ratio, and of course stage 3. So just if you can help, I mean, what sort of a portion you can attribute to this NACH, because stage 2 and stage 3 both have seen a sort of a jump, and also the provisioning coverage side. Typically, I mean, you had you were around 49% GS3 coverage at December, that you brought down around 45% to March. Now we are at sort of a 41, 42%. So what is sort of a driving and what sort of your comfort you have that is sort of you are taking this provisioning coverage progressively down? Thank you.
Well, when collections get delayed or interrupted, both our stage 2 and stage 3 will naturally increase. And that is precisely what has happened in the months of April and May, as I said earlier. This technical glitch did affect us from collecting the normal collection efficiency which we normally have. So that was affected. Because of that, movement of stage 2 and stage 3 was witnessed.
And as far as the overall PCR is concerned, I think there is only a marginal decline, but more importantly, directionally, if you see the visibility on the project loan portfolio in terms of recoverability and collections, just to give some numbers, there was also a collection of more than 100 crores during the quarter in terms of actual money collected in the project cases. So that is actually giving some level of visibility regarding the quality of assets on the project side, which is the most sticky and most difficult portion of the entire portfolio.
Yeah, but I mean, that project side NPAs are still, I mean, a reasonable sort of, almost like 5,000 crore or...
And there actually the provisioning coverage has not declined at all. Instead, in place of 36.88, the stage 3 has increased to 37.61.
Okay. And sir, what sort of explains your relatively, I would say, higher NPAs or GS3 in your individual lab? Because if I recall, these labs are a lot into salaried class. There, 8%, closer to 8% of stage 3 in, again, lab category. Again, is this something, where you expect improvement, or is this the broader trend line that you are okay with?
See, structurally, the product is a slightly higher delinquency product, and that is the reason why the pricing is also done in that manner. Having said that, the fact is that this also has got impacted because of the technical glitches that we discussed a few minutes back. And if you see, for example, in the the NHI category for the March ending quarter, it was around 6.5%. So from there it has increased. There also the total increase in amount net amount terms in stage 3 itself is about, say, 300 crores.
Okay, sir. Thank you. Thank you.
Thank you.
Thank you. We have a next question from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah, thanks for taking the question. So firstly, on the margin side, given that we are at the 3.2 now, and you mentioned like this is more of a operational, how confident we are in terms of sustaining it? Because I think we have been highlighting in terms of 2.5, 2.7 odd % margins. So now what would be our view with respect to the margin trajectory?
So if we see in the previous call, I think we had said around 2.5 or 2.55. Now probably we will be more looking at a range of between 2.6 to 2.75 kind of a band on a full year basis.
Okay. And the way it would come off in the coming quarters to settle, let's say, 2.6 to 2.75, that would be largely because of the catch-up on the borrowing side?
No, we could. I mean, there could be some reduction on the rate front by RBI towards the end of the financial year also. That is also possibly what we are trying to factor in.
But just assuming that the rates stay at where they are, then in terms of this yield on advances at 10.15, how should that ideally move? Because I think incremental cost of borrowing is something which you have mentioned, yeah.
The incremental cost of borrowing, if you see right now, there is a decent amount of stability on the rate side. Though the yield curve continues to be quite flattish, it has come off in terms of incremental cost. In the March quarter, we were clocking around 7.84. From there, it has come down to around 7.69, which is very close to the average that we are having at around 7.62. So, I would say cost line, by and large, will remain here only. There could be some exits of low-cost liabilities. So, to some extent, few basis points up or down, there could be a movement. Otherwise, on the pricing side, I think there could be a little bit of reduction in the lending rates going forward, owing to the stability in the interest rates indicated by Reserve Bank at this point in time.
Sure. And one last question with respect to growth. So obviously, a lot of efforts have gone into the transformation agenda, but still in terms of the disbursements, it's not been that strong all through. So how is the run rate currently? And finally, what is the kind of outlook which we would have with respect to disbursement and the loan growth?
Well, as I mentioned, a major restructuring took place in the months of March and April also regarding number one, change in the organizational structure and also our technological platform. So as I said also, we had some glitches in the technology platform. So partially the degrowth in our disbursement space, I would attribute partially to this. Number one, the technical problems which we had. And number two, since the organization got restructured, we opened 50 new area offices. We opened 44 new cluster offices. So there was a lot of, I would say, transition of manpower, also movement of manpower from places here and there. So naturally, as is normal, when a new person comes into a new office, it takes time. So the marketing effort could have been hit a bit. But this was only witnessed in the months of, as I said, April and May. From June onwards, we are back on track. July has been up to expectations. And going forward, I see that I think we should be recovering fast, and month-to-month improvement will be seen. Will be seen by us.
Yeah, so run rate for June would be?
Run rate for June approximately would be about 5,000.
Oh, so out of 10,800, 5,000 is in June.
June, yeah.
Okay, yeah. Thanks a lot, yeah.
Thank you. We have a next question from the line of Saurabh from JP Morgan. Please go ahead.
Hi, sir. Just one question on this NPA, that 4,000 crore in the project book. Could you just break up as to where are these recoveries being pursued? How much will be in NCLT? How much, you're trying to do this one time? settlement. So any color there will be great. Thank you.
Saurabh, actually, NCLT, we have received some positive decrees and orders in our favor. About, say, maybe around 80 crores of positive order has come in our favor, but the payment is yet to come. Total NCLT cases is close to 2,300.
Okay. 2,300 crores of the 44,000 is
2,300.
Okay, and how many projects will this be, Sudeep? So
around 20 odd accounts will be there. 22.
22. So thank you.
Thank you. We have our next question from the line of Aniket Kulkarni from BMSPL Capital. Please go ahead.
Good morning and thanks for the opportunity. So I had a broader question regarding the trends of your performance, right? So when we look at the last couple of years, the financials have been a bit volatile going in and out of the quarters. And so now looking at the types of numbers that you have displayed in the last two quarters, can we see some stability going ahead? And I mean, how do we see at the profitability and ROE numbers from now on?
It could impact leading to volatility, especially with respect to the provisions. COVID.
Hello.
Hello.
Yeah. See, actually, what volatility you had seen, especially that was in the year FY20, little bit of it in FY20, more pronounced in 21, 22 and 23. And a large amount of that volatility was pertaining to the ECL provisioning that has been quite fluctuating. And that probably was the reason because of the COVID impact on the asset quality. Now, if you see asset quality has remained stable, barring, of course, this recent quarter where there has been an uptick because of some technical matter. Apart from that, the quality of assets in the most sticky portion, that is the project loan, which actually is lumpy and led to the volatility, that has come down significantly. So if you remove everything, if you remove the ECL portion and you focus on the operational aspect of margins, then you will see that margins have been fairly stable in the 4.3 range, 4.3 to 4.35 range for the last 3 years. And last year, especially, it was around 2.41. So margin stability on the operational side, despite intra-quarter volatility on a year-on-year basis, has been fairly stable. The one thing which had resulted in the reported number volatility was the impact of ECL provisioning, which I agree with you, has been quite volatile moving from quarter to quarter. That is now likely to stabilize.
Okay. And another question is, could you talk a bit about your, efforts regarding diversifying your liabilities? I mean, you had said previously that these efforts will help you tackle the interest rate volatility in a better way, right? So can you just give some color on this?
Yeah, see, diversification of the liability profile, as I mentioned, is a part of our last 3-4 years. We have been striving towards it. 4-5 years back, there was a huge amount of dependence on the wholesale debt market. From there, we have reached a stage where we have more or less put diversified the liability in different pockets. The wholesale debt market continues to be the dominant portion, but apart from that, we have moved into the bank bank loans market. We have done an ECB, so geographically also we have been able to diversify. We have put a large amount of focus on our retail deposit franchise, which I'm still telling that we have not even scratched the surface of the possibility. There to diversify between the wholesale and the retail. And largely, if you see, we have tried to structure the liability profile in such a way that 50% roughly remains on the floating rate side and approximately 50 or 60% remains on the fixed rate side, so that interest rate movement also gets more or less hedged by this. So this will be a continuous process. Of course, the wholesale debt market, bond market, NCD will be a dominant one, more so because now you are aware that we are getting a space opened up because of the fact that one large player is moving out of the bond market, so there will be an improvement in the yields. There will be some benefit that we will be getting there.
Okay, thank you. And just one last data point question, if I can sneak it in. Can you give any sort of estimation on the expected provisions for the entire year, given that we have seen a slight spike in the NPAs in Q1, but for the entire year, can you give some idea on the provision number which you can see?
Well, 40 to 50 basis points, the credit cost. That would be the indication.
Okay. Thank you so much for answering your questions, and best of luck for the coming quarters.
Thank you. We have our next question from the line of Gao Zizwan from Schonfeld. Please go ahead.
Hey, sir. Thanks for the opportunity. I just want to clarify something because I was looking at your slide on the yield and cost of funds slide. It says that, for the first quarter, the yield is at 10.15%, and the cost of funds is at 7.62%, right? And then I was just looking at the fourth quarter 2023's full year number in your previous slides. For the full year of 2023, the yield is at 10%, and the cost of fund is at 7.63%, which is broadly similar to what we are seeing in the first quarter. But our margins went up from 2.4% for the full year of last year to 3.2% for the first quarter of this year. So I'm just wondering, what am I missing here? Because our cost of fund is the same versus full year of last year, and our yield went up 15 basis points versus the full year of last year per your disclosure, but our margin went up by 60 basis points.
Yeah, actually, what you are looking at is a spread between the cost of borrowed funds and the yield on a particular date. It is not based on monthly averages. When you're talking of margins, it is actually a derivation of the net interest income on each and every day of interest expended and interest collected. So that actually is what explains the difference. If you look at, there's been sequential improvement in the margins also from 2.93 to 3.21. That is how it should be seen, sequentially, not year on year.
Yeah, so how let's say if I look at the number of 10.15% yield on advances on portfolio, like how do you guys calculate the number? Is it like a last date of the
last date of the quarter?
Okay.
That is the weighted average yield on advances on the last date of the quarter.
Okay, understand. Got it. Thanks so much. Yeah, just want to clarify.
Thank you. We have our next question from the line of Ketan Gujarati from Quantum Advisors. Please go ahead.
Hello. Congratulations on the appointment, sir. I wanted to understand that when you are... hello?
Yeah.
Congratulations on your appointment, sir.
Thank you.
So I wanted to understand that when you were appointed, and so what kind of strategy you were asked to pursue on the sense of, let's say, a LAP, for example. Because I take your point that this year your NIMs are pretty much safe, around 2.5% plus. But going forward, I think, and again, the pressure will come on the home loan side, wherein we'll be even, hungry for yield. And at that time, will you be able to, grow your LAP book? And what will be the strategy? Because clearly, I see the last 7-8 years, the NPA numbers were much higher than our, regular home loan book. So can you just give me color on how you plan to protect your NIMs going forward and also the LAP strategy?
Well, the strategy is going to be, we're going to focus on retail, of course. Yes, on the project front, we'll be choosy as we have been in the past. We'll be looking at, because we have been facing pressure of NPAs on the project loan front. So we'll continue to be picky and choosy on the project loan front. And the other categories, quality focus along with profitability, we will be looking at the other categories on that basis. That will be the overall strategy for this year.
Okay, and one more question on the NPA front again. So we see that, so I'm purely comparing based on peers, that a lot of peers, they have also reported a very high number, probably higher than us as well. But either they have taken some correction measures, either a write-off or a resolution or a recovery. But our numbers are still very sticky. I am saying, even barring the technical glitches, let me take FY23 number. We are still at a very elevated level of NPA. So can you just give us a guidance? Because at the end of the day, when we are valuing your company, we need to understand how do I treat these assets? Because if I take you at face value also, the GNP numbers are not really, coming forward as, predictable. They have been same as it is, even if our asset base is growing. So just can you help me understand? Because I'm thinking from a 2-year out point of view. So just can you give me some comfort in, understanding how we are going to move forward?
Yeah. Ketan, as regards the NPA front, let me confess, we have not been very aggressive on OTS or roping in ARCs so far. So that is one area we are definitely going to look at this year. We'll be exploring all avenues. So far, our focus has been on going through the normal channels of convincing the borrower to repay or at the most the SARFAV action, etc. So these two areas of OTS and ARC needs to be explored. We have come out with an ARC policy within the organization. So that is one. The other we'll also be looking at, we have not written off much in the past few years. So we will also be looking at write-offs in the coming quarters. Technical write-offs, that is.
Okay, thank you. That's it from us.
Thank you.
Thank you. Ladies and gentlemen, we request you to restrict to one question at a time. You may join back the queue for follow-up questions. We'll take our next question from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Hello.
Hello.
Yeah, hello.
Yeah, thank you very much, sir, for the opportunity. So I just wanted to understand, in terms of your NIMs and ROA, so what sort of sustainable range we are looking at in both this front?
See, I think we've just given some kind of an indication. There's around 2.6 to 2.7, 2.8. That can be a broad range. Mm-hmm. That is as far as the margins are concerned on a full year basis.
Correct.
ROAs generally will be in the 1.3-ish to 1.4-ish on a blended all assets basis.
Okay. So clearly, the NIMs of 3.25% this quarter and even ROA of close to 2% is not sustainable, right?
I'll not use the word not sustainable, but only thing when we are talking about numbers, I'm focused only on the full year numbers.
Mm-hmm. Understood. And on the growth part, I think we are up 8%, right? And now with the problem solving and June onward, I think you're seeing improvement in disbursement. So what sort of loan book growth we are targeting this year? 10-15% or somewhere in that range?
Around 12 to 15, broadly.
Fair enough. Understood. Yep. That's it from my side, sir. Thank you.
On a full year basis, yes.
Yeah. Understood. All the very best, sir.
Thank you. We have our next question from the line of Raghav Garg from Ambit Capital. Please go ahead.
Hi. Thanks for the opportunity, sir. Just two questions from my side. One is when I look at your presentation for this quarter, you've given a blended cost of bank borrowings and NHB. So could you please split between what was the cost of bank borrowings and what was the cost for NHB borrowings, and then I'll take up my next question. Thanks.
The NHB borrowing cost is around 5.8%. Balance you can find out.
Sure, thanks. And sir, the second question is that, so I see that from the bond markets you're picking up money at around 7.7, 7.8%, and your outstanding cost of NCD borrowing is somewhere around 7.5%. You also just highlighted that there will be some maturities in this year. So is my understanding correct in saying that the kind of maturities that are coming up in this year are costing somewhere around 6.5%, and to the extent that there is a differential of 90 to 100 basis points, that is going to get repriced, and that will be the impact on the overall cost of borrowings?
See, your first assumption of the rate at which we are borrowing, I think we have done 10 years at 7.65,
yes.
Not at 7.8. So that is one thing. And as I mentioned, some improvement can be seen once the yield curve stabilizes, and because right now the yield curve is flat. So 5-year, 10-year, everything is almost selling at the same price. There could be some I would say, normalization of the yield curve, which will give could give some benefits. Yes, of course, there will be redemptions which will come up, and redemptions of past debt, including debt raised at higher levels and at lower levels, will be coming up regularly, in fact, throughout. And there could be some differential which could get added. But on the other side, there is a portion of the floating rate book also in the liability side, which might give us some benefit once there is a little bit of visibility on the, I would say, topping off of the yield curve.
Right. So, sir, on the whole, how would you expect your cost of liabilities to move? I mean, would there be any significant expansion?
At the beginning, I mentioned, right now we are borrowing very close to the weighted average cost of funds on the book side. So I would feel that it will largely remain stable within a band of, say, maybe 10 to 15 basis points.
Right. Fair enough. Thank you. That's all from my side, sir. Thanks.
Thank you. We have our next question from the line of Subhranshu Mishra from Phillip Capital. Please go ahead.
Hi, sir. Sir, just if you can speak about this organizational structural change that happened in March.
Please use your handset mode.
Hello?
Yes, please go ahead.
Yeah. Sir, if you can speak on the organizational structural changes that happened in March and April and the technical glitches, it just seems that a large organization is not geared up and doesn't have any backup plan for any kind of technical glitches which led to a slow disbursement. And one question, sir, why do we always want a CEO from LIC who's nominated, who may or may not have the requisite skills for housing finances? Why don't we get a professional CEO who knows how to run a housing finance business, and we can have the LIC nominee on the board? So if you could answer these questions. Thanks.
Well, as regards the LIC CEO, that has been the norm and the tradition, and I think LIC would, being the largest shareholder, I think wants to have its nominee as MD and CEO. So that is all I can comment on it. They take the call. So it is on LIC to consider what you are suggesting. And as regards the restructuring, well, the restructuring was felt it was necessary so that we could go down to the last mile, reach the customer. Expansion of offices, 50 new offices open, mostly in Tier 2 and Tier 3 towns, again, to increase our reach. And also the restructuring of the cluster offices, as we called, again, was taken with a view to streamline our basically loan sanctions and disbursement operations so that they happen faster, TAT is reduced, customer satisfaction improves. So that was on the restructuring front. And whenever changes do take place in an organization, there is bound to be some amount of distribution. As on the technological front, technology is a boon, but sometimes things do go wrong. Yes, we've learned our lessons. I'm very sure about that. And we have stabilized, as I said. We have stabilized June onwards. We're totally stable on the technology front. And going forward, I see that whatever we have done, whether on the technological front or on the organizational restructuring front, that is going to yield us excellent dividends.
And so this credit cost guidance of 40 to 50 bips when we have a large proportion of our book for salaried segment seems totally out of whack, sir. Is this mostly done to cater to the project loans and LAP and so on and so forth?
Yes, you're right.
Okay.
And it is likely to probably come down.
Come down to what, sir?
I cannot give a number right away, but it is likely to come down. But yes, we are the trajectory is of a declining trend.
So decline by how much, sir? 50%, 10%, 20%? How much will it decline?
If you look at the current quarter credit cost, it is around 5%. It is around 50 basis points. Last year, it was 78 basis points for a full year. I think the trend is quite visible.
Right, sir. Thank you, sir.
Thank you. We have our next question from the line of Vipul Kumar Shah from Sumangal Investment. Please go ahead.
Hi, sir. So, I have a question regarding the tenure of our CEO. I can understand that LIC can nominate its own CEO, but tenure of CEO is generally 2 to 3 years in our organization. Every 2 to 3 years, you get a change in CEO. So don't you think that disturbs the organization and the CEO should have a longer tenure?
Well, as I said, this is a call which LIC has to take. This is a norm, you can call it, that they have said that they nominate their own MDs and CEOs. And the MD and CEOs being LIC employees, of course, as you would have seen, the nomination is for a period of 5 years, but depends on the superannuation of the nominated MD and CEO. So if he superannuates in 2 years, 3 years, whenever he superannuates, he has to leave. So again, as I said, this is a call which LIC needs to take.
No, but for a large organization like LIC Housing Finance, you will take at least 1 to 2 years to get accustomed to the entire nitty-gritties of the business, and when that happens, the CEO gets transferred. So I think it is affecting the performance of the company. I am a shareholder, I am not an analyst, so just please convey my feelings to the LIC.
Sure. Point taken. I will be conveying your feelings.
And sir, another question is regarding your OPEX. So if I see the slide, it was in 2019 it was 2.74%, and now it is 4.36% for the last financial year. So what is the reason for such sharp jump in the OPEX over the course of 4 years, and how do you plan to correct it?
See, the OPEX is largely because of the IT interventions which we have done. As you would be aware, in the last 1.5 years, a lot of investments have gone in the IT as part of the project RED, which we had done in association with the Boston Consulting Group. How the OPEX gets rectified, of course, with higher volumes, better margins, and better profitability. That it's an investment rather than an expense.
So can you quantify what was the one-time impact of that expense, and going forward, what should be the range of OPEX which you would expect?
The OPEX going forward, it will be more or less on a trend. You have to see on a 3 to 4 year basis, because obviously when there is a large investment and large intervention done, it obviously can distort a particular quarter or a particular year. It has to be seen on an average of, say, last 3 years, and whatever is outcome of the last 3 years, that is going to be a stable number going forward.
No, but you have not quantified it, sir. So what should be the OPEX going forward for next 3 years?
Cost to income ratio, if you see, I think that is more important. Being a finance company, it all depends upon the cost to income ratio. Cost to income ratio largely is in the around 15 to 16% range. It will come down, but it will take maybe a couple of quarters or a couple of years to establish a trend.
And lastly, sir, regarding project loans, so over the years we are facing a lot of difficulties in this area. So isn't it better to leave that segment altogether, where I think we do not have the necessary expertise? So what are your views? That will be high.
That has been articulated at the beginning of the call regarding our strategy in each of the product segments have already been articulated.
I fail to understand what you are trying to communicate, sir.
So that what we have already articulated, that yes, all segments will be approached with caution in mind, considering the fact that whatever is the benefit or whatever is the returns, that is always a risk-adjusted return.
But I don't think we have got any returns from this particular vertical. All we have got is NPA only, and that has negatively impacted the results of the overall company over the years. So what is the point in continuing the business which is giving you negative return?
The overall share of project loan, for your information, is less than 4%, and it has been actually coming down from 8% to 4% in the last 3 years, 3 to 4 years. Okay, thank you.
Thank you.
Thank you. We have our next question from the line of Nilesh Jethani from BOI Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity. So two questions from my side. First is the repayment rate seems to be slightly lower in Q1 at 13%. Is the new normal or it is one time, and what sustainable number we can assume? And second question is on the direct loan sourcing. The share seems to be a little higher at 17%. So how to look at this number going forward? Yeah, thank you.
I think for all practical purposes, the Q1 numbers may not be exactly reflective because the business volumes have been on the lower side. As far as the repayment rate is concerned, that's actually the prepayment, I think, what is you are referring to. That is a function of liquidity in the external market. But it generally is between, say, 11 to 13 or thereabouts.
So can we expect this number to inch up?
No, it depends upon the liquidity situation of in the economy. Normally, the variation is not much.
Okay, and direct loan sourcing of 17%?
Yeah, that, as I mentioned, the first quarter numbers themselves were muted in terms of disbursement, so probably that is not a trend to build upon.
Okay, got it. Thank you.
Thank you. We have our next question from the line of Lalita from Anvil. Please go ahead.
Hello.
Yes, please go ahead.
Yeah, thank you. Thanks for the opportunity, sir, and congratulations on the quarter and your appointment also. So just one sense, our yields have moved up smartly in Q1. So I would appreciate if you
can you use your handset mode, please? You're not clear.
Yeah, sure. Hello. Am I audible?
Yes.
Yeah. So first of all, thank you for the opportunity, sir. Just wanted to understand, our yields have moved up very smartly in Q1. So if you can please share the current yields on the non-individual home loan part, which comprises around 16% of the home loan book, of the total loan book. So what is the yields that we are currently enjoying there, and what is the outlook that you are expecting for FY24? Thank you.
Sorry, you are asking about the non-housing individual.
Yes.
Non-housing individual incremental yield in the quarter was around 9.75, and on the non-housing corporate it is around 11.88.
Okay. Fine. So the blended comes to around 10.15, and if I am taking the rate that you are giving 8.5% for the on your website, then somewhere some segments we are seeing a very healthy kind of a yield. Am I
not able to understand your query, sir.
So basically, I want to understand that if I am saying 83.6% of our book is individual home loans, which on a ballpark number, if I see the rates to be 9% yields, then to reach at a 10.15% yield, the rest of the book should be somewhere around 13-14% plus yields.
No, not at all. In fact, I don't know where you have actually got the numbers from. If you see the website, it very clearly mentions that the starting yield is a particular number. It goes according to the CIBIL score.
Mm-hmm. Yes.
So that is to be seen, number one. Number two, you have to annualize it. Then you will get a proper number. So a mix of portfolio on the retail side also doesn't mean that every loan is being sold at the lowest rate.
Right. Correct. Okay, fine. I'll take this offline. Thank you.
Thank you. We have our next question from the line of Umang from Edelweiss. Please go ahead.
Yeah, hi, sir. So firstly, I just wanted to understand this cost improvement that you talked about, that you are being the largest player. That's true, and you will have some bond benefits. But I wanted to understand this benefit. We are already looking at this kind of benefit, or we are hoping for this kind of benefit that will kick in?
I think it has already started happening.
So that's why we are looking at rationalizing our cost of borrowings and probably move to a better linear portion, right?
Yes.
Okay. And so secondly, on the yield, I understand that there were some glitches, but still disbursement, I understand there was some reorganization that has happened. but disbursements, are they still happening at the original yield, or again we are going to compete with the market now that we are the largest player? Probably we would have a benefit over here. So I just wanted to understand on the yield front also.
No, can you kindly be a bit more clear, because not able to.
Sure. Can you hear me now?
No, I can hear you, but if you can explain your query.
Okay, sorry. So what I'm trying to ask is that the yield portion, so whatever incremental disbursements that have happened in June month, almost 50% of our entire disbursement, if this was happening at par to industry, or are we the ones who are now setting up the benchmark? As you rightly mentioned that now you are the standalone housing finance biggest company, so I just wanted to understand from your competitive standpoint.
No, yields, as far as yields are concerned, I think we have to be competitive. We are in a competitive business. Yes, HDFC Housing has exited the space, but it is still there in the lending, home loan lending market. Yes, as a large player, we would be looked upon to set the benchmarks. But again, yes, we have to be competitive. We have to look at all our peers and ensure that we are competing on the yield front also with them.
Okay, sir. Perfect. Great. Thank you so much. That's okay.
Thank you. We have a next question from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Sir, thank you for allowing me a follow-up question. Just one clarification I wanted. Given that your reported yields today, which I recall was 10.15, versus that when I look at the calculated yields for the full year, what we've seen over the past few quarters that the calculated yields somehow try to catch up with your reported yields, which sir explained this as on the last day of the quarter. So is there further room, even without taking more PLR hikes, which I'm guessing we have not done any more PLR hikes after the one that we did in April? Is there more room for further expansion in yields from here? Some repricing from the back book which can come in?
I think all the repricing on the asset side has been more or less complete. And going
even from the back book,
we are not expecting any rate hikes further. Some back book repricing can be on the lower side also. Some rewriting could be there, but on the higher side, the repricing is, unless there is further repo hikes, it is probably at this point in time, I think there is a pause.
Got it. So this is just one clarification here. So given that there are no more rate hikes on the annual, and from what I understand, typically when newer loans get originated, they are usually at a 40 to 50 basis points lower rate than the back book. So fair to say that, I mean, at least the yields in terms of this 10.15% number that you're seeing has peaked out and should incrementally at least start coming down?
No, Abhijit, I'm not able to understand. If you can kindly clarify.
Yeah. So all I wanted to understand is, given that, I mean, the yields today is 10.15, again, blended, and given that what we are given to understand, the incremental home loans that happen are usually at a rate which is anywhere around 40, 50 basis points lower than the back book. Then would it be fair to believe, as you keep building your home loan book over the next 1 year, this yield can start coming down from here?
Still not able to understand. Generally, it is all a market.
No problem. No problem, sir. I'll maybe reach out to you often. Thank you so much. Best wishes to you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to management for closing comments. Over to you, sir.
Yeah, thank you all. Thank you all for the interaction. In conclusion, I would like to assure you that we are now on a new path of growth. All these structural changes are in place. Our new technology platform is up and running. A lot of activities have already been done in Q1, and the total focus is on growth. This will continue. And I'm looking forward to decent growth in the coming quarter, Q2. I look forward to your support and continuous interaction. Thank you all.
Thank you. On behalf of Axis Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.